Now, investors have had their targets set on interest rates and inflation for quite some time now. But the recent shift in attention towards the Middle East has left many wondering about the situation unfolding between Israel and Hamas. Now, the current state of affairs in the region is nothing short of distressing, with significant implications for humanity at large. Now, the conflict between Israel and Gaza took a sharp turn, evolving into a full-scale war following a pivotal event. It was a moment that brought profound tragedy as Hamas, a Palestinian military group, launched a surprise attack resulting in devastating loss of hundreds of innocent lives. Now, in response, the Israeli military retaliated by declaring war, further exacerbating the situation. Now, you might be curious about how this geopolitical turmoil has reverberated through the financial markets, specifically in India. Let's find out. While we talk about that, Indians seem to be saving less. Well, at least that's what the RBI's household savings report says. You may ask why so? Let's find that out as well. You're watching Informed Investor, the Third Empire, an initiative by Research and Ranking. Let's begin. Now, the unfolding tragedy in the Middle East has undoubtedly cast a shadow of uncertainty over investors. Just 2 days after the initial attack on the Monday, that will be remembered with a heavy heart, both the Nifty and the Sensex indices experienced a downturn, shedding nearly 1 percentage point each. Now, the markets reacted with understandable caution. However, the very next day, in the face of the ongoing conflict in the Israel-Palestinian region, the Indian markets displayed remarkable resilience. Now, the Sensex surged by an impressive 566.97 points, representing a 0.87% increase to reach 66,079.36. Simultaneously, the Nifty, another vital index, closed 177.5 points higher, which is a gain of approximately 0.91 percentage points to close at 19,689.8. So what exactly is the impact of this war? Well, when we delve into the broader impact of this war, we find ourselves in the realm of uncertainty. Things are a bit uncertain since this situation is evolving. It's quite challenging to fully assess the economic consequence of the war at this point. It's possible that the war itself could cause some short-term weaknesses, but it is also possible that it could have bigger implications for the world economy as there is more significant concern. Now, if the conflict draws in other countries in the region and there are reports suggesting Iran's involvement, the impact could likely be a lot bigger. Now, Iran happens to be one of the major oil producers, and this could potentially trigger a sharp increase in crude oil prices for one, which would have an impact on the global economy already reeling under inflation and high interest rates. Now, amid the war between Hamas militant group and Israel, let's look at the significance of Iran, which is supposedly backing the Hamas group, and Israel. Now, Iran is a country holding some of the world's largest deposits of oil and natural gas reserves, ranking as the world's third largest oil and second largest natural gas reserve holder in 2021. Now, at the end of 2021, Iran accounted for 24% of the oil reserves in the Middle East and 12% of those in the world. Additionally, the Strait of Hormuz is the world's single most important oil passageway, forming a choke point between the Arabian Gulf and the Gulf of Oman. Now, the 39-kilometer strait is the only route to the open ocean for over 1/6 of the global oil production and 1/3 of the world's liquefied natural gas. Now, this includes most of the oil from the Organization of Petroleum Exporting Countries, or OPEC members, which include Saudi Arabia, Iran, the UAE, Kuwait. Qatar, the world's biggest exporter of LNG, sends all of its LNG through the strait as well. Now, any possible retaliation against Iran could endanger the passage of vessels through the Strait of Hormuz, which would significantly push up transport and insurance costs further, leading to supply chain disruptions and elevated crude oil prices. Now, the impact of the Israel-Hamas conflict on India could have consequences, especially in the following areas. First is going to be oil prices. One of the most immediate and tangible effects on India stems from its heavy reliance on oil imports. We all know that approximately 85% of India's crude oil requirements are met through imports. Now, as the conflict in the Middle East escalates, it often leads to disruptions in oil supplies and consequently a surge in the global oil prices. Now, this increase in oil prices can have a cascading effect on the Indian economy. Higher oil prices can translate into increased costs for various sectors. These increased costs can contribute to added inflationary pressures, which, if sustained, can erode the purchasing power of the average Indian. Now, furthermore, a spike in oil prices usually results in a higher outflow of dollars, which can put pressure on the exchange rate of the Indian rupee. Now, a weaker rupee in turn can make Indian exports more expensive, affecting international trade and potentially hindering economic competitiveness. Now, global market sentiment. Now, the global market sentiment also plays a pivotal role in India's economic health. If the conflict in the Middle East leads to increased geopolitical tensions and greater global uncertainty, foreign institutional investors may opt to withdraw their investments from emerging markets such as ours. Now, such withdrawals can trigger market volatility as India relies on foreign investments to a certain extent as well. We also talk about the economic impact on India through trade. India's exports to Israel account for only 1.1% of India's total merchandise exports according to the latest data. India's imports from Israel are machinery and equipment and pearls, diamonds and other precious and semi-precious stones, and India's trade numbers with Iran are almost negligible. So when talking about the economic impact on India through trade, we believe the impact will be minimal. So how should you as an investor react to this Israel-Hamas conflict? Well, when you find yourself in a situation like this as an investor, it's important to take the long-term approach. You see, throughout history, we've seen all sorts of crises, be it geopolitical tensions, act of terrorism, or even regional conflicts, and most of the time, their impact on the financial markets is like a passing storm. Now, take a look at the chart on your screen right now. Be it the Iraq war, the global financial crisis, the demonetization, Russia's invasion of Ukraine, or even the deadly SARS-CoV-2, or very well known as COVID virus, we see that amidst all of these, the markets have remarkable ability to bounce back and recover over time. So there is no need to hit the panic button, because like every other event, this too shall pass, but the markets will continue to rise and grow amidst all of these uncertainties. Now, India's household savings have dropped to a mere 5.1% in FY23 as per data from the Reserve Bank of India. Now, before we get into the nitty-gritty or the smaller details of the data, let's understand what exactly household savings are and how they lead to economic productivity of a country. Now, household savings encompass the money and the assets that individuals and families set aside for the future instead of immediately spending them. Now, this can take various forms such as money in the bank accounts, investment in stocks or bonds, or physical assets like real estate or even gold for that matter. Now, in the realm of macroeconomics, these savings are seen as critical source of funds available for investment. Now, investment in this context refers to the spending by businesses or governments on capital goods like machinery, factories, infrastructure and technology. These investments are typically made with the expectation of generating returns in the future and increasing the economy's productive capacity. Now, the pivotal point to understand is that savings provide the essential funds for these investments. When there is a high level of savings in an economy, it means there are more funds available for businesses and governments to invest in these capital goods. Now, this in turn has the potential to lead to incremental productivity, job creation and ultimate economic growth. So, the decline in household savings in India is a cause of concern as it could hinder the country's economic development and growth. Now, the relationship between savings and investments plays a significant role in India's economic growth story. Since 1950 to 51, both savings and investments as a percentage of the GDP in India have been on a consistent upward trajectory. Notably, investments have often exceeded savings, suggesting that the economy was sourcing funds from abroad to bridge the gap. Now, during the 2000s, there was a substantial increase in these percentages, with savings and investments reaching a peak of 37% and 40% of GDP respectively. However, since then, there has been a decline, with the share of savings and investments in the GDP dropping to around 30%, which is reminiscent of the levels seen in early 2000s. Coming to household savings as a component of this economic landscape are calculated by subtracting the aggregate financial liabilities from total financial assets. Now, household liabilities include loans from banks, non-banking financial companies and other sources, while assets encompass deposits with banks and other financial institutions like life insurance, provident funds, currencies, and other form of investments. Now, in the financial year 2022 to 2023, which spans from April 2022 to March 2023, net household savings were a mere 5.1% of the country's gross domestic product or GDP. This marks a significant decline from 8% of GDP in 2019 to 2020 and an even more significant drop from 11.5% recorded in the year when the pandemic struck. Now, a closer analysis of the data for the past 5 years reveals that the sharp decrease in household net financial savings is largely attributed to the surge in their financial liabilities. From FY22 to FY23, these financial liabilities surged by almost 53%, rising from 3.8% of the GDP to 5.8% of the GDP. Now, the decrease in household financial liabilities is a result of several factors interplaying in India's economic landscape. Now, this surge is closely tied to the country's recent consumption-driven GDP growth and an interesting consequence of greater financial inclusion. Here are the key contributing factors. The first is continued income stress. The aftermath of COVID-19 pandemic has continued to stress household incomes. Many people lost their jobs, making it essential for them to borrow to maintain their existing standard of living. High inflation. India has experienced high inflation rates which erode the purchasing power of money. Now, as a result, households find it increasingly difficult to meet their expenses. Next is easier access to bank loans. Banks have become more willing to lend to retail borrowers. Now, this change in lending behavior is partly due to reduced demand from the corporate borrowers and growing skepticism about them. Now, the situation where people are borrowing to maintain their living standards is a matter of absolute concern. Now, it suggests that the current consumption-driven economic growth may not be sustainable. Furthermore, the government relies on financial savings to fund infrastructure projects. Now, reduced savings means it might have to depend on volatile foreign capital, which can introduce economic instability. Now, in summary, the rise in household financial liabilities is a complex issue driven by various economic factors with implications that extend beyond individual households to the broader economy and government finances as a whole. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.